Hello, folks. Brandon Chapman with you today. It's a Monday video for the TheoTrade product project. Good to be with you on a very interesting day, very interesting week. The TotalTheo session, Bank Rout has Fed scrambling and investors picking up the pieces, trying to figure out what's going to happen. Now, this is an interesting start to the week as expectations. So if we look at SPX, we can look at the various expirations and what the expectations are. So you can kind of see where we're at tomorrow. $73 move being priced in by the end of the week. And we're talking, about 112 points. Expect volatility. Now, where did this scenario begin? We just got to go back here to early last week on Tuesday's meeting with Jerome Powell testifying before Congress, scheduled meeting. Leading into that session on Friday and on Monday, there was some bullish trade coming into banks like Key, for example. Bullish trade in housing stocks like DHI and I forgot the other one. DHI and Lennar, sorry. Lennar. And it looked like things were setting up for a nice bullish bounce as long as we had calm waters. But the issue was the very next day, as Powell was doing his testimony, interest rate expectations began to materially change. And that, of course, changed the prospect for regional banks specifically. And this is something I go over in my daily sessions on TheoTrade, and specifically on Tuesday, we looked at bearish trade on KRE targeting a 57, 52, and another spread at 58 and 53. Bottom line was, on Tuesday, with the breakout, as interest rate expectation, the Fed funds rate expectations changed materially, pricing in much, much higher rate increases. Well, all of a sudden, we're pricing in 52, 53 over the course of the next month. And of course, things began to escalate in the regional bank space. Bank of the Ozarks on Tuesday. So these were two plays along with KeyBank were ones I reviewed on Tuesday for our TheoTrade clients. Bank of the Ozark had significant trades down around the 40 strike. That beat then was rolled down to 35 as things progressed throughout the week, as they began to aim lower and lower, targeting lower and lower prices in these regional banks. And so this is something that I spent a considerable time last week during our daily sessions. And so again, we're just began to continue to unwind. And even on Friday, there was a litany of stocks within the financial space that just saw significant downside expectation and potential pressures. Now, Bank of the Ozarks ended up holding up well, but stocks like KeyBank didn't. So it made sense for on Friday to kind of throw it out there across multiple stocks in the financial space, looking for some of these to hit. And on KeyBank on Friday, it was an April 14 strike that was bought on the put side, looking for more downside. And so now all of a sudden we have this facility that the government created over the weekend. The idea we're going to throw $25 billion at it just didn't seem like it was enough. And of course, along with SVIB rather, we had we had Signature Bank go down as well today, and I forgot to write down the symbol there, SBNY. Anyway, so again, we're seeing further escalation. Now, the realities are what? People say, well, yeah, but these banks are perfectly fine if it weren't for the run on deposits. Now, the thing we have to realize that many of these companies, businesses, these banks, in this case, let's just talk about Silicon Valley Bank, they had significant unrealized losses. In fact, Silicon Valley Bank at the end of last year had about $16 billion in equity. That equity was wiped out in unrealized losses. And again, why is this significant? As interest rates go up, those bonds lose value. These are unrealized losses. And the problem is the duration, or by the time these bonds mature, given the current rate expectations from the Federal Reserve, they were expected to lose money. These were unrealized losses that are likely going to become realized losses. And so all of a sudden we have this picture where all of a sudden all these people had allowed to store potentially or deposit, tens or hundreds of millions of dollars of uninsured deposits. Now all of a sudden the market's trying to rethink how they might be positioning themselves. So we don't know what further issues are going to materialize with regional banks or smaller banks, more lending focused banks or bigger banks. Where does the money go? Does it go towards the strategically important banks like a Wells Fargo, like a JP Morgan? Does it, Bank of America? Well, Bank of America has about 40% of its equity as of last week, taking in unrealized losses. They have significant exposure, but they are strategically important and maybe more likely to get bailed out in more of a negative scenario. A la, if we go back to the investment banks, we let Lehman Brothers go, we let Bear Stearns go, but we allowed Goldman Sachs and Morgan Stanley to become banks, even though they didn't exactly technically qualify. So the question is, how bad is it going to get? And we just don't know. What we do know is that expect further policy measures likely to help kind of stem the tide of liquidation. But we saw this in 2008 as something would pop up during the week. The Federal Reserve would meet on the weekend, launch some policy on Monday, get a little short squeeze, and then that would fade away. Then they'd have to step in again repeatedly. And as a function, it caused leveraged funds like SKF. So if we go back here in the Wayback Machine to 20 years ago, switch this to a week, what you'll see back in 2008, this product had some big swings at time, but at the end of the day, if you held this product all year long, you lost around 10% or more of your funds from the end of 2007 to the end of 2008 for that entire year. Why? It's because these products have daily resets. And so these big short squeezes cause them to get stuck in neutral. So be careful with leveraged products if you're trying to bet negatively on financials. Probably best to use options to be able to accomplish this. And the reality is this is exactly what's happening. And given the amount of decline we've seen in regional banks, the bets are coming in on both sides, because what we do know, while we don't know direction, again, going back to the expected move for the S&P, it's $73 tomorrow. If we look at KRE for this week, you've got over $6 of expected movement. That's over 15%. What we do expect to see is volatility. And so as a function, as you look at some of the trade that is coming through, and we'll kind of highlight a few of these just on KRE to give you an example. So for example, for April, hit the wrong one there. This 45 and 40. This also tied into the $50 strike in here. And you can see it on the time and sales. And again, there's a lot of stuff that's going on today. Some of it's getting buried. You'll see these three strike prices being traded along with the 45 and 50 down here and another 40. Now that's that same tranche. Sorry about that. So 22,000, 22,000, 44,000. In essence, what you have is kind of a rolling down in effect from the $50 strike down here to a 45 and 40 strike. What does this suggest? It's a spread, vertical spread. Look at the possibility of 40. If you look at the current price as of the close today, you look at 510, you look at $2.80. We're basically talking about $2.30 on a $5 spread. This was pricing a lot cheaper earlier today. But again, the skewness is beneficial. If you buy 44, sell at 42 or 41, you'll see the volatility is expanding. A 40s at 82%. So you can buy the lower volatility, sell the higher vol. And again, you could do a 44 and 41 for about $1.15 in here on a $4 wide spread. And so again, it gives you kind of an idea of how to potentially play the downside. And that wasn't the only one in the mix here as well. You also saw a roll down to $43. So again, providing kind of this downside potential here, 43 stretching down to 40 and maybe beyond. But on the bullish side, again, what if something happens overnight? What if there's a new facility announced? What if we start to see a bit of a squeeze, a short squeeze, and we drive the prices higher in carry? Well, what's on the other side of the trade here? Well, if we look at a 31 March, scroll up here a little bit, 16,000 contracts, mostly bought at the 50. So there's those that are taking the upside bet that the volatility swing is going to go the other direction, that some sort of calming is going to take place. And you also see in the April expiration down here again, we've got a 55. So what is it? 55 and 60 out here. So again, the idea is they're taking these kind of spread trades. Now the pricing on these spreads aren't good or as good. You're buying the higher vol, selling the lower vol. But again, it's still a bullish opportunity, limited risk, very high reward, low probability, but banking on a bigger move, maybe to 55, maybe down to 40. But you see these trades lining up that have limited risk, very high potential reward, but lower probability, just banking on the fact that there's going to be some volatile movements. Now, what's going to cause KRE to potentially burst higher in the coming days? For example, Goldman and Barclays are expecting the Fed to pause in their next meeting, which is coming up next week. Well, let's take a look at current market expectations for the Fed funds futures. Notice what happened here. This is 4.75% to 5%. The current rate's 4.5% to 4.75%. 56% right there. But notice what's going on here. We're flipping from expecting them to raise potentially 50 basis points to possibly keeping it the same. And you see a week ago at 68%, 1 month ago at 90%. But we began last week to really price in 5.25 as kind of a real scenario, greater than most 50% probability that they're going to raise 50 basis points in the next meeting and potentially get upwards of 6.25%. What's happening, and you saw this continue to evolve throughout the day today, that we began to increasingly price in the idea that they're going to pause in the next meeting. But how can they pause when inflation is running hotter than expected? Well, look at this. CPI is coming out tomorrow. It's going to be a big deal. We got the year-over-year number at 6% expected. We got the month-over-month number at 4.4%, and the core PPI number, CPI number, at 0.4%. How can they, if this comes out hotter than expected, how can they pull back on interest rate expectations only to allow inflation to run away? Right now, however, we saw the biggest drop in one-year inflation expectations in history. 0.8% decline to 4.2%. So all of a sudden, we're talking about a Fed funds rate at 4.5%, and we have one-year inflation expectations of 4.2%. That is the lowest since May of 2021, and it's the largest decline on record for that one-year inflation expectation. So we're getting this kind of print for the previous month, but forward expectations, we're starting to see inflation expectations decline. And what better than a financial crisis to potentially create lower expected inflation? And a lot of stuff is hitting right now that could be very, very negative for the market, negative for the economy. And we might see some near-term kind of rip higher here. I mean, the S&P has held up reasonably well. If you look at the SPY today, it was only down 0.4%. We finished in the middle of the range. So if there is a policy measure that comes out that the market likes, that stabilizes the banking sector, at least for the near term, expect we could see a big, big rally tomorrow. Otherwise, if not, does another bank failure lead to further dominoes to the downside until they really have to force their hand? And another question is, what if they come out something tonight and we have a really hot inflation print? Now, there has been some recent adjustments to how the CPI is calculated, and maybe they know it's going to come out under. It opens the door. But either scenario, we're talking about easing of monetary policy. This cannot be good for the dollar, which is obviously bullish on gold. And there was some big trade in gold today to the upside. And, again, if you're looking for something that is a low probability but high reward, low risk trade, if the Fed kind of messes it up and creates more of an inflation dynamic where we have stagnant growth and rising prices, a weaker dollar creating the higher prices, this is where gold can really shine. And what you saw today with GLD, specifically, this is for the May expiration in here, you'll see an upside spread trade, buying the 185, selling the 200 today, looking for substantial upside. And again, that's not a retail trader coming here at 50,000 contracts and buying the 185 and selling the 200. And notice that the vol skew, buying 18 and selling 20, is favorable. And this might cost you. Let's say this is around 320-ish. You come out here to 200. You're able to sell that for about maybe 80, 87 cents. What we're talking about here is a trade that may cost you about 235, 240, but has a 15-point spread. So you got about $2.50 of risk, or 250 per contract, with potentially, again, about $12.50 of upside if we do see that scenario play out. So a little bit of risk, a lot of reward. This may be the best play, that if the Fed can somehow quell the concerns of the banking space, and we see a kind of a snapback there, and it's likely going to come at the expense of the dollar and higher inflation, which future inflation, or at least a weaker dollar in the near term, which may help propel gold higher. And it's the same rationale that's helping to propel Bitcoin, by the way, today, which was up 21%. Where do you put money? Post the great financial crisis, we saw further concentration, further centralization, fewer banks, more regulations, right? That has not exactly made the banking system better. It only just coordinated the inflationist efforts. The issue is that further centralization is not the answer, but decentralization. And the idea, but again, I mean, are we going to allow the banking system to further decentralize? The reality is probably not. Of course, they've got the central bank digital currency in tow. They've got other measures to further concentrate and centralize the management of the banking space, who can get loans, how you can get loans, yada, yada, yada. But as we look at Bitcoin, Bitcoin's breaking out today because this is the perfect antidote, gold as well, to what's happening. The idea that if you're earning a yield in a demand deposit, like a checking account, the fact of the matter is you are taking risk. There is nothing backing those deposits. Whereas a decentralized, crypto like cryptocurrency, specifically Bitcoin, because not all crypto is really money. It's some of them, a lot of it's probably like buying stock in a company for all intents and purposes. But Bitcoin is, for all intents and purposes, money. And it is a place where you don't need a third party, right? You don't have to store it anywhere. But it would be negative yielding if you had to protect it or store it in a facility. And so the realities of decentralizing the banking system does make it so you're not going to get paid to have money sitting in a bank on demand with nothing backing it. Of course, they changed that the reserve requirements back in 2021. So again, nothing's backing any of these deposits other than the hope that maybe there's FDIC, which a private company can insure a certain amount of deposits. They also have a line of credit that might help them in that process. But again, they cannot withstand a major bank failure. And past crises like WAMU, for example, Washington Mutual, they basically sold it off to JP Morgan on the cheap, wiping out the equity holders, but allowing depositors to keep their money in the bank, converts to a Chase Bank. Everything is good. Well, not really. But the fact is we just allay those concerns and live for another day of a market, a financial crisis, which is exactly what we're in at the moment. The question is, as a trading opportunity, you're trying to make sense of which way does it resolve. Something like Huntington Bank, looking at today, down 16%. I've always shared in any fundamental class that I do, I always tell them, look, you can't look at the financials. You cannot assess the fundamentals of financial companies and really utilities either. So anytime we try to look into fundamentals of companies, we exclude banks and utilities and zero in on more traditional companies that you can do more traditional analysis with. The fact of the matter is, who can make sense of any of these banks' financials and really come to a solid conclusion and understand the company? The reality is that it's very difficult, if not impossible, to do. So you got to look at the share price. So Huntington Bank down 16% today. Is this the next one to go under? Who knows? The point is that there are ways you can decide to trade based on that understanding. And the options market does give you that ability with limited risk and potentially unlimited upside to be able to do it. Today, buying the April 10 for about 70 cents here at the mid, 75 cents at the ask. This does create an opportunity to play the downside. And if you're just doing a single option, you benefit if volatility rises significantly. These options will gain both on price and volatility. If we go back here, let's go back 3 years. In post-COVID, this was down around $7. Could this reasonably in the coming days go to 7? Again, it would be unlikely, but possible. Look at how fast we declined from the current level before settling in down here at 7 back during the COVID crash. So again, this could take a little bit of time, or it could get there quickly, or not at all. But the reality is options provide you the opportunity with limited risk and significant upside if things go awry. So if you're trying to make a trade based on certain outcomes, as long as you risk relatively small amounts of money per trade, there is opportunity of continuing to play these and just assuming that the volatility is there, and even taking sides a little bit if you want to take some bullish, some bearish, because you are seeing today traders doing that at the moment. AIG, this is one that was kind of at the center of the great financial crisis. And of course, they sued the Federal Reserve, et cetera. But this is down big over the last several days. AIG today, this was a roll. And so as you see, as you have options that move in the money, what do? This 52.50, you sell it and you buy further out of the money at 45. In this case, you take off about $3 of risk or book some profits. You've got $1.50 on the table, and what do? You let it ride in case there's further downside. This opening up that $45 area on AIG down here, and we close at 50. That's another 10% downside. But once you kind of get in the mode and you're rolling, it can pay sometimes to leave some of it on the table by rolling down, even within the same expiration. And definitely a lot of rolls going on today. Let me show you one other on GLD I kind of missed earlier. But GLD, this is a 31 March, right? So again, if the Fed comes out, they're able to stem the tide of selling. Well, what does that mean for the dollar? Probably does not bode well. But for GLD, it was the 179 strike this was last week, actually. Sorry, this was last Friday. The 179 strike was bought last Friday. And again, we're up about $4 today. So again, there's been bullish trade built in gold, and today in gold stocks. If we look at GDX, a nice bounce today up about $1.90 or 7%. We look at this is the September's expiration. So now we're trying to get through the summer, the debt ceiling, and all this other stuff. What does this mean for financials? What does this mean for gold stocks specifically? Notice how here 49,000 contracts buying the 42, selling the 50, looking at the bigger potential move up to $50. And of course, this would take a major move in gold. But the idea is it takes very little money. The skew is favorable. So again, you're putting a little bit on the table just in case things go haywire. The market rallies, the dollar declines, gold goes up. We're kind of building in kind of a stagflationary scenario. And you're only putting up, maybe 20, 30 cents for an $8 spread. So again, this is one way. If you're taking those big bets, just don't bet big, bet small, but have high reward, low risk. Again, low probability. These not many of these would have to necessarily pay off to be very impactful potentially to your portfolio. Let's take a look at the VIX because, the market is kind of settling in today. We look at the VIX. We failed to really, trade higher, much higher than 28. We kind of peeled back off the highs. As you consider, well, where's volatility going? VXX is not a good tracker of the VIX because it has futures and it's rolling. And normally futures have a rising term structure that has a negative roll. It hurts the product. So you see these go down. But VXX has made a nice rally here. Hasn't gotten back to October, okay? So realize these are not something you hold long term. But on the flip side today, on VXX, there was some trade out here for the April expiration, betting on some downside to the VXX, buying the 47, selling the 43 there. So again, you are seeing some of these bearish bets come in, expecting the VIX to fall. And again, I'm not encouraging necessarily to trade VXX, but it just gives you an idea of how some are taking the road of expecting the Fed to come in, help support the market. We rally off the lows, VIX comes down. You have the other side taking big bets that we continue to sell off. We just don't know right now who's going to be right, but the investors are just, the traders are picking up the pieces and making the decision. What they are banking on is there's going to be further volatility. So again, just remember that as you think about treasuries. So the change in interest rate expectations allowed TLT to rally. Also maybe a safety play as well. We're back up against resistance. And what you did see in TLT is that saying, look, well, if we start to price in more of an inflationary outlook, the Fed pulls back on interest rate, but again, we start to build the inflation scenario. What does that do to TLT? And I'm on September here, but TLT today, you saw 24 March expiration, expecting a bit of a pullback. Okay, so again, it's not all honky-dory for the bond market as well, but some expectation that TLT may come in from its highs. If you look at corporate credit like HYG, this has remained relatively subdued, but risk spreads have widened out as this has fallen, and products like IEI have risen dramatically. This is something I talked about a week ago in one of my sessions about when do risk spreads start to blow out. We're just starting to see it here in the last few days with buying of treasuries and the lack of buying of high yield credit. Or if you look at LQD, a little bit of a pop yesterday, not much today. Point being is that risk spreads are starting to widen out. And this means more borrowing costs from an already leveraged corporate sector. BITO, so the rally in Bitcoin catches a rally in BITO, BITO. However, today's trade in BITO, for the April expiration, you're seeing down here 52,000 contracts, mostly bought there at the $10 strike price. These companies are not necessarily in a great position to capitalize on higher Bitcoin prices. They weren't generating positive operating cash flow at much higher Bitcoin levels. And so again, we get the big pop like today up 23%, 22%. We may see this trade ease back. You might want to see this reverse be a little bit before you really take that side. But the idea is in the bearish scenario here, again, rising volatility, buying a put spread, buying a higher strike, selling a lower strike helps create a low cost, high reward opportunity, low probability. But if things start to kind of settle back in, you'd expect BITO, Bitcoin related companies, mining companies, etc., should relax back. And again, this is looking at $10 by April's expiration. Let's finish with two up here. So if inflation expectations are going to fall because of a lack of growth, does that mean oil prices are going to be pressured? Oil's back at support again. There's the possibility the feds might come in and fill the strategic petroleum reserve. We start to get below 70. This may be holding up there the price of oil. When you look at the term structure, we're pretty flat out here for the next several months. And this has flattened a little bit more since last week. Point being is there's not much indication of an oversupply or an undersupply. We do have a lot of oil. We are producing higher amounts of oil. And so near historic level production of oil. So the question is, what direction does oil go? If inflation starts to come in, if inflation expectations are correct, does this mean lower oil prices? Well, who knows? But at least for oil stocks, there is pressure right now. This is something that early last week, we looked at a company called Rig, back up here at the high, looking for an in-out type spread, looking for this to break down based on option activity. We saw further pressure midweek on XLE as we began to break down here on the 8th. And we've kind of see this move in. We're a bit oversold now, but now we have resistance at about 82.50. And today's wide-ranging candle, do we start to break the low and head down? Now you'll notice with today's trade in the June expiration, and you're seeing 82,000 contracts down here, buying the 58 and selling the 53. Again, who knows what's going to happen? But the point is, can you place these kind of outrageous bets, low risk, high reward, very low probability, low cost, in case things go haywire? And again, this is one of those kind of plays today, sizable trade for June, looking at significantly lower oil prices. That would obviously dovetail with a potential recession. But we contrast that what's going on with Qs today, And this is more near term for a March expiration. Maybe some expectation we start to catch a bid in technology names and we start to see it rally higher. You notice out here at the $300 strike, mostly bought, again, out of the money, looking for kind of a snapback here. Again, you can kind of see both sides of the trade coming in with significant size. The only question, it's a matter of direction, maybe not so much of a question of whether it's going to be big moves in the coming days. It's just that we just don't know the direction. So can you start to make some of these trades depending on your outlook or balancing it out, just expecting volatility? That's kind of the story today. And as you're trying to pick up the pieces on a difficult week, this may be the way you look to play it. A little bit of risk out there, large potential reward, but realizing the low probability of these trades may mean you lose on all of them. So you got to be prepared to do that and just have a little bit of allocation if you're going to do it. Anyway, it's been a pleasure being with you today. We'll see what the week holds. We'll catch you back next Monday for a new video. Thank you.